Welcome to this week's problem set, which is problem set number 3, and where we will deal with the taxation system, how it works and what it means. And in particular, we will consider different examples of circumstances where we have families which consists of a particular amount of members, and then we have fictional and non-fictional tax brackets, and we actually calculate the tax payments of the individuals that are covered in the exercises. In addition, we will talk a little bit about whether a tax system is progressive or regressive, and so on. So in exercise 1, we are given or we are confronted with a fictional nation, so the nation of Fish-Khazar, and we have a tax bracket there or a tax schedule. And given this tax schedule, what we are going to do in the sub exercises is that we are going to calculate marginal and average tax rates for the families. So let us start by writing down what the tax schedule in this nation of Fish-Khazar actually is. So what we have is, sorry, one second. Yes, no, it's fine. So the tax bracket or tax schedule is looking in the following way. So for the first, so from 0 to 20,000 valoops, this is the currency in this country. What we have is tax rate of 5%. Then from 20,000 to 50,000, so 20,001 until 50,000 valoops. There we have 20%. And finally, for anything above 50,000, so starting from 50,000 and $1 valoop until, let's call it infinity. In this case, we have 50% taxes. So this is describing the tax schedule. And in addition, we have an exemption. So we have a 5,000 valoop exemption for each member of the family. Okay, so for instance, if there is a family which has 2 members and the total income of the family is 100,000, then the taxable income wouldn't be 100,000, but it would be 100,000 minus 2 times 5,000, because we have to consider the exemption. And this gives us then 90,000 valoops of taxable income. On this 90,000, we will apply the tax schedule and not on the 100,000 of income. Yeah, because we first subtract the exemptions and then we basically, apply the tax schedule on the taxable income. So the first step is calculate taxable income. And the second step is apply tax schedule. And we will be doing this for 2 different families which have different incomes. Okay, so sub exercise A, we call it the Jamil family. So this family has 3 members, 3 members, and 60,000 Valoops earnings per year. And we are asked to calculate the marginal and average tax rates. So let us first calculate the taxable income. So the taxable income would be 60,000 minus the amount of members in the family, so 3, times the exemption rate, so the amount or the height of exemption, which is 5,000. So 3 times 5,000, and this gives us a taxable income of 45,000. And now what we have is that 45,000 is between 20,000 and 1 and 50,000. Therefore, if we take a look on the tax schedule, the marginal tax rate here will be 5%. Sorry, it will be, of course, 20%. So therefore, marginal tax rate is 5%, 20, sorry, 20%. So what we then need to calculate next is the average tax rate. So let us, no, it's fine like this. So yeah, let me just write it down here. So what we need to calculate first before we can calculate the average tax rate is the total liability of, or the total tax liability of the family. So in order to do this, we need to calculate how much taxes the family is paying in total. And since the tax schedule depends on the amount of income, it changes depending on which part of the income we are considering, which part of the taxable income. We have to do some kind of a piecewise calculation here. So the first, so for average tax rate, first compute total tax liability. And what can we say here? So the first 20,000, is taxed at 5%. Next 25,000 is taxed at 20%. So we had a total taxable income of 45,000, and from this 45,000, the first 20,000 is taxed by 5%, and the next 25,000 is taxed with 20%. And what we then have is basically the total liability. So therefore, total tax liability is the following. So it would be 0.05. So this is the 5% times 20,000 plus 0.2 times 25,000. And this is equal to 6,000. Therefore, the average tax rate is the following. So it's the total tax liability, so 6,000, divided by the total income, so not the total taxable income, but the total income of the family, which is 60,000. And this is equal to 0.1. Therefore, the average tax rate is 10%. Okay, so in sub-exercise B, we have the Buba family. Let me just go back to the description. And for the Buba family, what we have is we have 5 members, and the family is earning 100,000 values per year. And we are asked to calculate again the marginal and average tax rates. Okay, so let me go back. So what do we have? We have 100,000. 100,000. So this is 10,000, 100,000 values. Household income. And we have 5 members. So 5 family members. So the steps here are quite similar to the steps that we had before. So first, let us calculate the taxable income. So the taxable income is 100,000 minus the amount of family members, or the number of family members, times the exemption, which is 5,000, and this is equal to 75,000. So 75,000 is larger than 50,000. Therefore, the marginal tax rate will be 50%. And then we go on to calculate the average tax rate as we did in the sub exercise before. So what we need to do, so for average tax rate, again, we need to calculate the total tax liability for this family. So the first 20,000 will be, there we will have 5% of taxes. So it's 0.05 times 20,000 plus for the next 30,000 we will have, so until 50,000 we will have 20% tax rate, so 0.2 times 30,000. And then we covered 50,000 of the total taxable income, and the remaining 25,000 will be taxed with 50%. So then we add 0.5 times 25,000. And if you calculate this, this is equal to 19,500. So then the average tax rate, so let me correct this. So this is the, what I calculated above here is the total tax liability, just such that you don't get confused. Okay, so the 90,500 here, this is the total tax liability, and the average tax rate is then total tax liability divided by total household income. So 19,500 divided by 100,000. And this is equal to 0.195, and hence the average tax rate of the Buber family is 19.5%. This brings us to sub-exercise C. In sub-exercise C, we have a sudden change in the tax code in that instead of having a tax schedule where for different levels of income you pay different taxes, you have a flat tax of 30%, which means that you have a linear tax, which is the same independent of how much the individuals are earning. In addition, we have not a 5,000, but now a 10,000 family member exemption. And the question is, would this change in the tax system make the system more progressive, more regressive, or neither? Or maybe both. Okay, so this is the question that we have here. So let us go back and then try to analyze the case. So the first thing that you, of course, can observe is that there is a kind of a regressive effect. So change is not progressive. Why is that? Now, everybody pays the same tax rate independent of their income. Okay, so independent of how much the individuals would earn, when you flat the tax schedule, in that now you have an extreme case where you have a 30% marginal tax rate for everybody, then yeah, independent of whether you're a millionaire or whether you're earning $20,000 or baloops for this case, you basically face the same marginal tax rate. Okay, so let's just give an example. An individual with 20,000 loops pays or faces the same tax rate as an individual with, for instance, 1 million loops. Okay, so this kind of the flattening of the tax schedule is kind of not progressive. So it's regressive. Now there is another effect which is due to the due to the change in the exemption. So so I can write something down here. So yeah, let me just check this. So please add here change is not progressive due to flattening. So the change is not progressive due to the flattening, and the change, this is the other effect, change in exemption. So because we have an increase in exemption, this can be progressive. Okay, so let me give an example. we have individual 1. Let's call them individual A. So we have individual A. He has income. He has an income per single. It's important that it's a single individual. So there is no household here, but it's a single individual A. He has an income of 11,000 loops. Now the second, so we would have another individual. So the second individual, which we will denote by individual B, he has an income of 15,000 loops. And what we can do now is we can calculate the average tax rate under the new system, so the tax schedule that I showed you for sub-exercises B and C, and then compare it with this new tax schedule, yeah, where we have a flat tax rate and a higher exemption. So let's go to the old situation. So old schedule or old system. Individual A. So what is the tax liability of individual A? So individual A has 11,000 of 11,000 loops. So from this we subtract the 5,000 exemption. So we have for A, so individual A, the taxable income is what? So the taxable income is 11,000 minus 5,000, so it's 6,000. Therefore, the tax liability is 6,000 times the tax rate that this individual is paying, which is 0.5. And let me just be sure to calculate this correctly. This should be 300, but I just want to get sure. 1 second. Yes, this is 300. Therefore, the average tax rate would be 300 divided by the total income, which was 11,000. And this is equal to 2.7, so 0.027, and hence 2.7%. This is the average tax rate of individual A under the old system. Now let's consider individual B. So for individual B, he had a total income of 15,000, so his taxable income is 15,000 minus 5,000, so it's 10,000. Therefore, the tax liability is 10,000 times the marginal tax rate for this tax bracket. So this is also 0.05. And this should be 500, if I'm not mistaken. Yes. So this is 500. Therefore, the average tax rate here is 500 divided by the total income of individual B, which is 15,000. And this is 0.03, roughly 0.03, such that So yeah, it's 0.03 and the 3 is coming forever. So let's just say it's 0.03. So the marginal or the average tax rate here is 3.3%. Okay, so those are the average tax rate payments under the old system. Now let us consider the new system. So under the new system, we have a flat tax rate. So for individual A, the taxable income is now 11,000 minus 10,000, so it's 1,000. So we can apply the new tax schedule on this 1,000 units of, or 1,000 values of taxable income. Therefore, in the next step, what we calculate is the tax liability. And the tax liability is simply now, please be careful, here we have a 30% tax rate, so it's 0.3 times 1,000, and this is equal to 300. Sure. So this is 300, and therefore the average tax rate is 300 divided by 11,000, and this is equal to what we had before, so 0.027. So the average tax rate is still 2.7%. Now let us consider individual B. So individual B has now a taxable income of 5,000. So it's his 15,000 minus the 10,000 exemption. His tax liability is given by 0.3 times 5,000, which is equal to 1,500. So you see, this is substantially more than, there is 1 0 too much here. So this is substantially more than the tax liability of individual A. And now we can calculate the average tax rate. So the average tax rate, which is then 1,500 divided by the total household income. So this was 16,000. And if we calculate this, what we have is 0.0393 roughly. Therefore, we have a 9.3% average tax rate here. Sorry, there's a mistake here. It's not 16,000, it's 15,000. Let me just correct this real quick. So then we have, and this is, then this is equal to 0.1, and therefore we have an average tax rate of 10%. And now if you compare the average tax rate of individual A and individual B, you see that the difference under the new system is much higher than the difference under the old system. Okay, so for some individuals in this model or in this country, what we would have is that for a low income range, what we would have is a progression. Yeah? So because here individuals who have, on a new system, individuals who have higher income will pay or have higher average tax rates compared to individuals with lower income. But as I said before, this doesn't hold generally, because if you still compare somebody who is very rich, so who has a high total income, and compare him to another individual who has very low income, then this exemption wouldn't help there so much because, yeah, both are basically paying the same tax rate. So this effect would be stronger there. So basically, the answer to this question is that, yeah, we would have both types of effects. So a change would be both more progressive, but also more regressive.